everyone. I think we'll make a start. I hope you can all hear me, and I hope you can all see the screen that I'm sharing. So my name is Lisa Dowling, and I'm the Senior VAT Manager with Taxback International. And the presentation today is to talk through global indirect tax news and trends that are happening around the world in VAT and GST. And there has been many in recent times, and a huge move towards digitisation. So the focus will be on digitisation, technological changes in the world of VAT and GST. The main talking points for today's presentation will be on digital tax measures, including SAFT, which is the standard audit file for tax, control lists, making tax digital in the UK, electronic invoicing, real-time reporting. So we'll go through each one of those, and we'll see the trends that are happening around the world in relation to those reporting requirements and how that might impact on your business. And we'll also look at the worldwide spread of VAT and GST. We've seen the introduction of GST in India last year. We're seeing the introduction of VAT in the GCC, with the introduction of VAT in UAE and KSA at the beginning of this year, and other Gulf states to follow. And we've seen also in Malaysia their introduction of GST and then removal of the GST in Malaysia this year. We look also at changes and trends with VAT rates around Europe and beyond. What way VAT rates are going? Are they going up and down? And what impact that has? And then we look at indirect tax news and rule changes around the world, focusing on online sellers, the changes that are happening there, US sales tax, the Wayfair case recently in the Supreme Court, and the impact that has for online sellers in the US, and the VAT Action Plan, what that is. Okay, so digital tax measures then, to talk about digital tax measures, we're seeing great ideas in the area of digital tax, great technological advances, but no standardisation across jurisdictions. And where we have no standardizations, then we have differences across jurisdictions. So when we're talking about technological advances and also differences across jurisdictions, that poses problems for global businesses to comply with the new requirements that are being enforced by the various jurisdictions. And so we see differences then in what data is collected, and we see differences on how that is reported, when it is reported, and the thresholds that we have to adhere to. So once we breach a threshold, we need to provide additional information. The thresholds vary by jurisdiction, and so it makes it difficult for global businesses to comply with new requirements. So we're seeing differences in requirements and reporting requirements in SAFT, which is the standard audit file for tax. We're seeing differences in control lists that have to be submitted to tax offices. We're seeing differences now with making tax digital in the UK, electronic invoicing requirements, and real-time reporting. And all of these differences create a huge compliance burden for global businesses, and also may spell the death of the VAT return as we know it, while tax offices are looking for more and more detail. And so the need to submit a monthly or quarterly VAT return is becoming redundant. So just when we talk about the standard file for tax, SAFT requirements, just to note that it was developed by the OECD, and it's an electronic format which enables the transfer of data from organisations to tax authorities in a standardised electronic format. So this data then enables authorities to conduct more efficient and effective VAT inspections, because ultimately they're receiving more data from organisations. So Austria, France, Luxembourg, Portugal, Lithuania, Norway and Poland have all introduced SAFT requirements. But again, there's no international standard list of data elements for SAFT, so we're seeing differences across all of these jurisdictions. Notably, in many of these countries, it's not a requirement to submit SAFT declarations with your VAT return. It's just that you have to keep your VAT data in a certain format, and the tax offices have to be able to access that data in the event of a VAT audit. In Poland, though, for example, it's a requirement to submit that SAFT data on a monthly basis along with your VAT return. And Poland has since updated the SAFT recently They want to replace the current SAFT with a new version of the SAFT that will ultimately remove the need to file the VAT return and the SAFT separately in Poland. So this new version of their SAFT will replace the requirement to submit a VAT return. So we're told that that's going to happen from 2019. We don't have a specific date in 2019, but you can see the way the tax offices are moving towards differences in reporting requirements, and SAFT might ultimately replace the VAT return. Currently in Poland, the VAT return is a summary of your VAT data, and your SAFT then is broken down transaction line. So this new SAFT will incorporate a summary of your data and also your transaction line. So you can see how that will remove the need to submit two separate declarations. And then this ultimate SAFT will meet all of the requirements of the Polish tax office. Many tax offices have increased the advanced reporting obligations in the form of control lists. And the SAFT is a form of a control list. But in other jurisdictions, there's other types of control lists. For example, we have in Italy the Spesa Metro, in Hungary we have the M-sheet, so there's all these, in Romania we have the Form 394. So there's all these additional requirements that global businesses have to be aware of and have to understand the reporting requirements associated with them. So just a little bit more about control lists then. So these are domestic VAT listings and they have two main goals. So they are used in the fight against VAT fraud by giving a tax administration a tool that allows easier and faster detection of fraudsters and fraudulent chains. They increase voluntary compliance by introducing a form of third-party reporting where each trader identifies its clients and or suppliers as well as the amount of the transaction. So these control lists are really a transaction by transaction piece of information that's reported to the tax office. Currently, there are at least 12 member states in the European Union that collect data on domestic transactions. VAT listing is a domestic measure, so again, there's no international standard on data collected and on the format in which it has to be presented. So this, again, produces a huge burden, compliance burden for global business. The common themes that we find with advanced reporting is no standardisation. It is a fight against VAT fraud, which is why it's kind of attractive for lots of EU member states. It increases the compliance burden for global organisations. It improves the risk analysis that the tax offices can carry out. It improves their auditing techniques, but it increases compliance, and it's a collection of data and enforcing compliance in various forms. So we see that there is a real move and a fight against VAT fraud. There's a real move to collecting specific, accurate data to improve risk analysis for the tax office and to improve their auditing techniques. It will automatically increase compliance levels, but it also automatically increases compliance burden risk for global organisations. So then we move on to the UK then, and making tax digital for VAT in the UK. And this is another form of digitisation in the fight against VAT fraud and to force compliance in the UK. So making tax digital for VAT in the UK was introduced to make HM Revenue Customs one of the most digitally advanced tax administrations in the world. And the first step towards making tax digital for VAT will happen in April 2019. It should be noted that making tax digital for VAT is not real-time reporting. It will follow the same reporting periods that you currently follow, but your communication with the UK tax office will be done through digitised reporting. It's an online digitised reporting through a specified software. Okay, so from April 2019, organisations will need to submit VAT returns in a digital format via an application programming interface, so API. So it's a specific software that will have to be used for communication with HM Revenue Customs. So the transitioning from manual to digital records will be challenging, and spreadsheet users will need bridging software or API-enabled spreadsheet to digitally submit the VAT return data to HM Revenue Customs. HM Revenue Customs will publish a list of approved software when the public testing opens. In the meantime, they have published a list of software developers who have gone through the successful testing. So there is a list of software and there's continuous updates to that list of software developers. But there hasn't yet been a list of approved software. And there is going to be a soft landing until the 31st of March 2020 for VAT returns commencing between the 1st of April 2019 and the 31st of March 2020. HM Revenue Customs will not enforce the requirement to have digital links between software programs that contribute to the VAT return workings. So the only requirement from April 2019 is that the communication directly with HM Revenue Customs of the VAT data has to be digitized and communicated through this specific software. After that, organizations need to figure out how they will digitally link the different softwares that make up the VAT data before it's communicated to HM Revenue Customs. But they have until 2020 to figure that part out. So during the soft landing period then, the use of cut, copy and paste or manual transposition of data is acceptable. Okay, so further digitisation, what is the future going to look like? We can kind of see what the future might look like when we look to China and India. In China and India, they have immediate reconciliation of your supplier's sales to populate your inputs and to avail of input VAT credit. So in India, for example, you can't avail of input VAT credit unless your supplier has uploaded their sales invoice and you have reviewed that sales invoice and accepted it, and then you can avail of that input VAT credit. So this kind of immediate reporting is very prevalent in the likes of China and India, who have recently introduced GST. And so we can see that our own VAT world might move to a similar scenario. So it will be immediate reporting of invoices, and then you won't be able to claim your inputs unless you are avail of an input VAT credit unless your supplier has uploaded the related sales invoice. So we're seeing movements towards electronic invoicing in Italy, and Portugal has just announced as well that they will introduce electronic invoicing for B2G, so business to government transactions. In Italy, the conditions for electronic invoicing were as follows. And with effect from the 1st of January 2019, invoices and related corrections for supplies of goods and services between parties resident, established or VAT registered in Italy must be issued electronically. On the 2nd of July, however, there was some clarification, and it said that the electronic invoicing obligation is not mandatory where the supplier is a non-resident taxable person registered in Italy for VAT purposes through direct VAT identification or appointment of a VAT representative. So there's some clarification there and some leniency there for companies that are not registered, or not resident in Italy. Okay, so we also see the digitization and real-time reporting in Spain and Hungary recently. In Spain, it was called Immediate Supply of Information, or SII. It related to large taxpayers filing monthly VAT returns in Spain, and it was the real-time reporting of sales and purchase data. Originally 8 days from the date of the sales invoice, or from the date on which the purchase invoice was booked to the company's account, and now it's 4 days. And the biggest headache that we have experienced with SII is the reporting of purchase data. So with sales data, you are in control and you issue your sales invoice and you can report them within the 4 days. With purchases data, it's a little bit more difficult. We've had lots of discussions with the tax office and our clients in relation to what booked means. So if I receive a purchase invoice, what does it mean to be booked to my system, particularly when I'm dealing with maybe employee travel expenses? So when is it considered that they are booked to my system? Is it when it was sent for payment, when my payment run is done, where I reimburse my employees? So there's all of these further considerations to take into account when you're dealing with SII and purchases. So reporting of purchases include the reporting of employee expenses and also non-deductible items. So SII in Spain is the first time where we've really seen the VAT office, the VAT authorities focus on non-deductible items when it comes to purchases. So in Spain, you have an obligation to report all of your compliant input invoices, whether they're deductible or not. which makes it very time-consuming and arduous, and our clients still don't have any input VAT recovery on the back of that. So with SII, you automatically transfer your data, and it goes through the SII system, and it kicks back any exceptions on the report if any of the data is not in the required format. For example, if the supplier VAT registration number is missing a prefix. So then you get this exception list that you need to go through. So it just has added a huge amount of compliance burden for companies in Spain that fall under these SII requirements. In Hungary, they also introduced a real-time reporting from the 1st of July this year, and we all kind of breathed a sigh of relief when we realised that it would only be applicable to sales transactions. So I think Hungary looked at the Spanish model and thought, we're not touching purchases, it's such a huge burden and such a big headache. We're going to make this rule applicable to sales only. So in Hungary, real-time reporting began, as I say, from the 1st of July 2018, and it relates to Hungarian VAT registered entities that issue invoices with a VAT amount above 100,000 Hungarian forints, which is the equivalent of €320, to another entity VAT registered in Hungary. The additional requirement with Hungary is that the reporting of those sales transactions has to be done without delay to the Hungarian tax office, meaning that invoices must be reported immediately as they are issued without any human intervention. So there's a difference there between Spain and Hungary. With Spain, they could be reported in 4 days of their issue date. In Hungary, they have to be reported immediately as they are issued without human intervention. So Hungary have gone an extra step further in kind of the technological advances here, in that they have to be reported immediately without human intervention. So this includes businesses established outside Hungary but VAT registered in Hungary. So again, it only relates to sales, it only relates to domestic transactions, it only relates to business transactions, and it only relates to invoices with VAT of more than 100,000 Hungarian forints. Okay, so that kind of completes the digitisation of VAT and the way things are moving. We're going to move on to the worldwide spread of VAT, looking at India, GCC, and Malaysia. So in India, GST was introduced on the 1st of July 2017. That journey began, though, towards the GST model in 2000, when a committee was set up to draft the law, and then it took a further 17 years for that law to evolve. So on the 1st of July 2017, the law came into effect, and GST was mainly introduced to remove the cascading effect on the sale of goods and services. And since tax on tax is eliminated in the current GST regime, the cost of goods should decrease. So GST in India is mainly technologically driven. All activities like registration, return filing, application for refund, and response to notices needs to be done online through the GST portal. And there are 3 main taxes applicable under the system: CGST, SGST, and IGST. So that's central GST, state GST, and interstate GST. Okay, and this GST regime was introduced to remove up to 14 different indirect taxes that they had. These 3 taxes, CGST, SGST, and IGST, has replaced all of those taxes listed above 1 to 14. And this is kind of what the workings of the new GST system looks like, and it just shows the interaction of the state GST and the centre GST. And if you follow the transaction flow, you can see how each of the taxes are reported to state and to centre at the same time. We're going to send out these slides after, so you can work through these flows yourself if ever you have a question in relation to how Indian GST works. And then this model just shows you the interaction of the GST model when you're talking about interstate transactions. Okay, so the major common features and the reason GST was introduced was to produce a common return that would serve the purpose of both central and state government. There are now 8 forms provided for in the GST business process for filing of VAT returns. Most of the average taxpayers will file about four of these forms. with Indian GST, it's good to note that currently you have to file your sales information and your purchase information separately in separate returns. So it's a different model to one that we're used to in Europe. The filing of returns, though, shall be completed online, and all taxes can be paid online. Just to note then that the GST Council has now approved a new simplified return filing process under which all taxpayers will have to file a maximum of one monthly return. So there's a move towards this one return, which will be much appreciated. Sales and purchases will be then reported in one return. You'll be able to avail of an input credit based on invoices uploaded by your suppliers. So I spoke about that before. This system where you can only avail of your input tax credit once your supplier has issued their sales invoice and they have uploaded that to the GST system, and you accept that, you lock it, you pay it, and you can avail of your input VAT credit. So the VAT return table will be auto-populated with basic sales and purchase information based on invoices uploaded. So that shows you another technological advance. In India, and Europe may follow, in that your VAT return table will be auto-populated by the information that you report on your invoices once your invoices are uploaded. And the new VAT return form is expected to be modular in format and will be completed based on the profile of your trader. So the flow is upload the invoice, lock it, pay it, avail of your input VAT credit, and that information auto-populates the VAT return. So that's like a real move towards digitisation in India. And I can imagine that that's the way VAT in Europe will look down the line too. So this new change is expected to happen with the VAT return in India from 2019. And then we'll move on a little bit then to VAT in GCC. VAT was introduced in GCC from the 1st of January 2018. In 2016, the 6 member states of the Gulf Cooperative Council signed an agreement binding each to introduce a national value-added tax rate at 5%. So we have seen that Saudi Arabia and the United Arab Emirates began implementing VAT on January the 1st, 2018. When will we see the other 4 member states follow suit? We're expecting that will happen from kind of mid-Q3 2019. So VAT in the UAE and KSA is very similar to the EU VAT system. There is some consistency between the states, but like Europe, there are differing lists of exemptions and zero-rated supplies. You could nearly consider GCC to follow the same model as Europe, but each state will have its own rules. So we're seeing differences in the exemptions and zero-rated supplies. For example, education in the UAE is typically zero-rated. In Saudi Arabia, typically exempt from VAT for public schools and VATable at the standard rate for private schools. There's differences in the VAT return filing periods and deadlines. So there will be, I would imagine, differences across all 6 states once VAT is rolled out in the other 4. And then Malaysia has kind of gone against the flow of the world, and they have scrapped GST from the 1st of June 2018. So GST was introduced in 2015 and has since been blamed for the rising cost of living in Malaysia. So they are reverting back to the sales and services tax, and that was reintroduced on the 1st of September 2018. So with the proposition that the sales and services tax will decrease living expenses to the general population, economists now have concerns about how the government will find new sources to match the GST revenue collection. So SST is only charged on taxable goods manufactured by a person or a business that has an annual turnover exceeding about $169,000. And among the items that will not be taxed are rice, cooking oil, bread, and baby products, which is why it's kind of a popular introduction for the general population in Malaysia. Okay, and we'll also then just look at the trends in VAT rates and GST rates. In general, the VAT rates are coming down around Europe. As many of the countries move out of recession, they're looking to reduce their VAT rates. Austria has reduced its VAT rate on accommodation, or will reduce it on the 1st of November from 13% to 10%. Croatia is moving down 1% on the standard VAT rate from 2019. Similarly, Iceland. Romania as well announced that it would reduce its rate to 18% on the 1st of January 2019. I've just heard news that that may have been abandoned, so we'll keep an eye on that one. The Netherlands will increase its reduced rate from 6% to 9% from the 1st of January 2019, and Russia is set to increase its standard rate from 18 to 20% from the 1st of January 2019, mainly to help fund election promises of improved healthcare and infrastructure. And so that is why that one has gone up. So we're seeing a typical trend of an overall reduction in the VAT rate across Europe by approximately 1%. And then just in other news and rule changes, we're going to focus on online sellers and the digital economy and the VAT Action Plan. So looking at a rule change for online sellers applicable to Australia, from the 1st of July 2018, Australian GST will apply to sales of low-value goods, so goods with a customs value of 1,000 Australian dollars or less, imported by consumers into Australia. So we're looking at online sales here predominantly. So businesses with sales subject to Australian GST of 70,000 Australian dollars or more to consumers in Australia within a 12-month period will need to register with the Australian Tax Office, collect GST at the point of sale, and remit the GST to the Australian Tax Office. And we're going to see similar rules in New Zealand from October 2019. So if you're an online seller in Europe and you sell to consumers in Australia, you're going to have to monitor the value of those sales. And if you exceed the threshold of 75,000 Australian dollars or more to consumers within a 12-month period, then you're going to have a registration obligation in Australia. You'll have to register there, charge GST, collect GST, and pay it over to the Australian Tax Office. And there is a simplified registration process also introduced in line with this to help online sellers to comply with this obligation. And we'd imagine there'd be a similar simplification in New Zealand once they introduce a similar rule in October 2019. In Russia, their change focused on e-services to Russian consumers, and from January 2017, non-resident providers of e-services to Russian consumers have had to register and charge Russian VAT. Another change then expected in January 19, the rule will be extended to non-resident providers of B2B services to Russian businesses, removing the application of the reverse charge mechanism to such transactions. So that's quite interesting. So foreign businesses then will be required to register by the 15th of February 2019 via the Federal Tax Services portal for online service providers to report VAT on B2B services to Russian businesses. So VAT returns and payments will be due on a quarterly basis by the 25th day of the month following the reporting period. So that's quite a significant change in Russia in relation to B2B services. And then in the US, there's also been some updates for online sellers. Usually the basic rule for collecting sales tax from online sales is that if your business has a physical presence or nexus in a state, you must collect applicable sales tax from online customers in that state. If you don't have a physical presence there, you generally do not have to collect sales tax for online sales. However, in June of 2018, the US Supreme Court issued a ruling that will likely change this exemption to collecting sales tax. States are expected to begin collecting sales taxes regardless of having a physical presence in the state. And this happened as a result of the case South Dakota versus Wayfair, which changed this rule. So states can now choose to tax most internet sales, only a matter of time before all states apply this tax. So online retailers will have to track sales levels and tax law changes in all states where they do business. So it has a huge impact for online sellers in the US. Retailers will have to set up systems to collect the sales tax for all states. Online retailers will have to increase price to consumers. And the big winners here are the bricks and mortar businesses who will benefit from this change. Moving on then to the VAT Action Plan. So the VAT Action Plan has been said to be the biggest reform of EU VAT rules in a quarter of a century. And it was introduced to tackle cross-border VAT fraud. So the EU Commission proposes a change that would see VAT charged on cross-border trade between businesses. So that's huge. So it's a charge of VAT on cross-border trade between businesses. So currently we apply the zero rate of VAT on cross-border trade and a reverse charge mechanism. So this, the VAT Action Plan introduces the removal of that rule and instead a VAT charge on cross-border trade between businesses. So as part of the EU Commission's proposal, businesses will be able to avail of a one-stop shop to account for the and pay the related VAT. So they are introducing kind of simplifications around this because it has a significant increase in compliance burden for businesses. And the Commission has also proposed a further simplification in the form of a certified taxable person. So the recipient can apply to be a certified taxable business, and then if they are a certified taxable person, and then if they are a certified taxable person, you can issue your sales invoice still with 0% VAT. But if not, you will have to charge local VAT, local meaning in the place where your recipient is established, local VAT on your sale of cross-border supply, B2B cross-border supply of goods. And so this rule change is due to enter into application from 2022. So it's something that we need to keep an eye on. And for the future of EU distance sales, there's a simplification to the distance sales rules by the EU Commission in October 2017. We'll see the extension also of the mini one-stop shop, which currently applies to e-services. So the current domestic thresholds in each member state will be abolished and will be replaced by a single annual threshold of €10,000 per year. And once you exceed that threshold, you will have to charge VAT in the member state in which your customer is established. But there is a simplification whereby you'll be able to use the mini one-stop shop to report those sales. And so you won't have to have registrations in 28 member states. And that rule change is due to come into effect from the 1st of January 2021. So it's one to track also. So we're seeing an overall trend to digitized reporting. We're seeing immediate reporting of sales. We're seeing the pre-population of inputs, and we're seeing anti-fraud measures and risk analysis. So this is the overall trend that we're seeing. So again, we're talking about digitized reporting and technological advances. They're all great ideas, but we're seeing no standardization. So it's imposing huge compliance burden on global businesses. And we're hoping that the EU Commission will take all these great ideas and put them into one format. But we did see that they tried to do that a few years ago with the introduction of a standardised VAT return form, but couldn't get agreement with 28 member states. So for the moment, I think we're stuck with non-standardised, digitized reporting. Okay, thank you for your attention. That's the end of the presentation. I see that we have some questions coming through, and I think what we'll do is go through the questions and report to you after this presentation. We're also recording the presentation and we'll send it out to everybody in attendance.